All right, let's talk about something that affects pretty much everyone, the tax year. It sounds basic, right? But here's a question for you. Do you actually have to follow the same January to December calendar that's hanging on your wall? Let's dig in. So, really think about it. Does your financial year absolutely have to wrap up on December 31st? For most of us, the answer feels like a definite yes. But what you might not know is that the IRS actually gives you another way to do things. Okay, so before we jump into the different options, let's make sure we're all on the same page. When the IRS talks about a tax year, what exactly are they talking about? It's really simple when you break it down. Your tax year is just the official 12-month stretch you use for all your financial record keeping. Think of it like a big bucket. For 12 months, you fill it with all your income, your expenses, everything. And then, at the end, you report what's in that bucket on one tax return. It's the building block for, well, all of your taxes. Now, there are really two main players in this game. Let's start with the one we all know, the one that's basically the default setting for most of us, the calendar year. Yeah, this one's super straightforward. It kicks off on January 1st and ends, you guessed it, on December 31st. It's clean, it's predictable, and it lines up perfectly with the regular calendar. No surprises here. So who's using this? Well, pretty much everybody. It's the go-to for almost all individual taxpayers and a whole lot of small businesses. And here's the really important part. If you don't keep any formal books or records for your finances, the IRS just automatically puts you on the calendar year. It's the default if you haven't chosen otherwise. But what if your business has its own unique rhythm? What if that January to December schedule just doesn't quite fit? Well, that's where our other option, the fiscal year, steps into the spotlight. And this one is all about flexibility. So, a fiscal year is also a 12-month period. But here's the kicker, the part that changes everything. It can end on the last day of any month besides December. And that single detail is what makes it such a powerful tool for certain businesses. Okay, let's put them side by side. The calendar year is rigid. It ends on December 31st, end of story. The fiscal year, on the other hand, can be tailored to match a company's natural business flow. I mean, think about a big retailer. Their busiest time is the holiday rush, right? It makes way more sense for their year to end after all that chaos, not smack dab in the middle of it. Let's look at some examples so this really clicks. A fiscal year might run from July 1st to June 30th. That's actually pretty common for government agencies or schools. Or maybe it starts on February 1st and ends on January 31st. The only rule is that it has to be 12 months in a row. The start and end dates are up to you. And here's a really cool, kind of niche version of this. It's called the 52-53-week year. Now, this is a special type of fiscal year that always ends on the same day of the week, say, the last Friday in June. Why would you do that? Well, retailers love this because it means they can compare sales from one year to the next with perfect consistency. Every year has the exact same number of Saturdays, for example. It's pretty smart. Now, after all this talk about flexibility and choosing your own path, you might be thinking you can just pick whatever you want. But hold on a second. The IRS has some very strict, non-negotiable rules for when you actually don't get a choice in the matter. So here's the bottom line. You are required. You must use a calendar year if any of these things are true for you. Basically, if you don't keep formal financial records or you don't really have a set accounting period, then the calendar year is it. You're defaulted into it. You can't just claim a fiscal year without the records to back it up. In these cases, it's the calendar year, no ifs, ands, or buts. So let's wrap this all up with a little thought experiment. Now that you know the difference, think about a super seasonal business, like a ski resort. How could a resort benefit by choosing a fiscal year that ends on, say, April 30th? Well, it would let them capture their entire busy season, from the first snowflake to the final spring slush, all in one financial report. It's a perfect example of how picking the right tax year isn't just about paperwork, it can be a really sharp business move.